Hey everyone, I'm back. I want to go ahead and talk to you about a potential decline in home prices and what I calculated. I think it's very exciting considering it's math and it's the reality of things. It's not perception, it's not all that BS that you're seeing with the fear mongering and clickbait. It's actual math that I want to break down for you today. Hey everyone, so home prices may fall by a double-digit percentage depending on how greatly impacted GDP is in a negative fashion, right? So with all the perception going out there and the fear-mongering and the clickbait that could be happening, things can get even worse. However, I want to use math, and the way I'm going to do that is by utilizing some graphs and calculations done by some professors, two professors actually, that are gurus at this, and they're at the Florida Atlantic University. So I want to share that with you today. Overall though, I suspect most coastal California markets to remain stabilized and not so much go down like other markets that probably would get more impacted. But this would really need to affect GDP, the stock market, unemployment to rise and then stay there for quite some time, inflationary pressure to elevate mortgage rates, and the list goes on and on. That's how home prices will fall or could fall.
The reasons why real estate prices likely won't crash like 2008 is explained in my previous video that you should watch if you haven't already. Recently, we've seen homes for sale reduce their list price due to the rapid growth of mortgage rates that took place around June. To add to the fire, over the last 2 years, many sellers have pushed the envelope every month further and further by listing their property more than the market value because they're ultimately testing the market and being rewarded. A flood of homes hasn't hit the market though, because it's said about 72% of homeowners with a loan have a mortgage at or below 4%, so they don't have an incentive to sell. If you watch my full count videos, I mentioned that recently on about episode 3. Now, there are many other reasons for flood of homes likely to not hit the market, but again, check out my last video on Vargas real estate. Only 2 of the last 6 recessions led to a drop in property values: the savings and loan scandal of 1991 and the Great Recession. Both were caused by some missteps of the housing industry. The other 4 recessions resulted in appreciating housing prices.
This is not a good seller strategy to constantly push the envelope and try and get more for their home. They need a price at market value because buyers don't want to pay above market value anymore. Mortgage rates have just gone up too much. And when you see these list prices come down, it's not that the home value is losing value itself. It's just that it's a correction going back just several months ago before mortgage rates were so high. So we're seeing like low single-digit percentage numbers in home prices come down on the list price because of that. So keep that in mind as a seller. List at market value. I've said it several months ago. Anyone else that hasn't seen that video, you're seeing this video now. I hope you price at market value if you're planning to sell your home.
So a few years back, I was reading a financial magazine and I reached out to the professor mentioned in the article. I got in touch with him because I wanted to learn more. We stayed in touch and I came across his calculation he's done with his colleague at FAU. They ranked the top 100 housing markets that they feel is overpriced. So they use the average price for the city versus the expected price that they believe prices should be based on their statistical models.
Okay everyone, so now I have the whiteboard here so I can kind of show you how this works. The expected price point is the solid line that the professors used with their own calculations through regression analysis, and they also then incorporated the average price point, or the average price home value index according to Zillow per period. The only thing I wish that they would have done, because last time we've seen house prices go down before 2006 period was in 1991, but we only have up until 1996, which is unfortunate, but it is what it is. The other unfortunate situation that I wish we would have had here is they're using the city of LA, Long Beach, and Anaheim, and they're incorporating all 3 of them into this model. I wish they would have done it separately, but beggars can't be choosers, right? I'm grateful for the fact that we even have this. So with that being said, I want to get into it. The expected price point that they had here in 2006 compared to the actual average that Zillow had was 67.20%, which is just extremely wild considering how much of a premium of overpriced the homes were at that time, according to their model, of course. And, you know, look at the gap between 2022, between that. So it's 12.26% to 67% range. I mean, that's just crazy. Again, toxic mortgages in 2006 period, the financial crisis was egregious to say the least. All the toxic mortgages, the moral hazard, et cetera, you've seen my videos. So with that said, now we're gonna look at, or I'm gonna talk about percentages referring to the actual prices of homes according to the Zillow Home Value Index. But before I go any further, I just wanna point something out to you. I am not talking, when I'm speaking about this, Zillow use a range of percentiles. So they're not talking about every price point in the market. They're not including every price point, okay? So they're using a wide range of percentiles, more so in the middle of the bell curve rather than all of it, right? So they're using the 35th percentile to the 65th percentile. So they're not going to go with the cheapest home in those areas, and they're not going to go with the most expensive $20 million home in those areas. They're going to go with more of the middle figures to be more accurate. I ended up finding what the price point was, where the Zillow average price point, where it actually fell to. So here it was about 30%, which is what it was in Southern California. If you look into what price points fell, it was around, people say 27 to 32%, right? But the actual price point where it bottomed, this actually should be a little bit lower. According to the math I did, prices fell 37% from the top to the bottom. So I figure it's going to have a similar situation here to some degree. So with that, I came to the calculation. It'll fall a certain percentage here, but it'll end up bottoming a little bit later. And the price I got was negative 18%, considering what I did was I calculated the proportions from here to here, and I got negative 18%. But I also calculated what the minimum would be, and that's negative 6%. But I always like to use the middle of it, right? So the average within the average. And it's about negative 12.2% is what I think realistically it'll probably be. So instead of falling 37% like it did then, I think it'll likely fall about 12.2%. We'll see what happens. But here's the thing, folks. Everything's a lot different now than it was then, right? There's been a lot of government spending, a lot of money printing, way more than it was back then. So I do see at this period it was much worse than today. The only thing different that I find a little bit concerning is the fact that the media, the social media, all the masses of media is more involved in our lives today. It's not just the corporations within the big media, it's the social media corporations too, but it's the consumer. The consumer feeds into this. They upload their own fear-mongering news reports and things like that, or their perception is what it is, opinion. Their perception ends up, you know, changing other people's minds. So this is the reality, but that reality can shift to something worse if the perception is much worse. So this is based off of math, and you know, we'll see how it goes. I hope you let me know your thoughts. And they also have one for Miami. In Miami, the premium is actually similar to this one, which is a little bit wild. I just hope that they utilized more qualitative data considering all the migration from states that went to Miami. I think that's why prices went up. So the gap probably should be a little bit smaller, but that's just my opinion. So on to the further note, I do want to mention, as we know, there's an inverse relationship between mortgage rates and home prices. The more rapid and the more the mortgage rates stay up, eventually home prices will come down, which is the situation we have here. So there's a complete inverse relationship with the rate percentage and the price point, right? So as this goes up, the mortgage interest rates, prices will come down, okay? So keep that in mind. Again, the supply issue is the fact that there's so much less inventory than there is the number of people that want a home. There's more people that want a home than there are homes available for sale, and that's kind of the situation we are in, why home prices kind of have stabilized over the years going upward. And it's an issue that we have, you know, going all the way back to 2006 with the ages, and even the 1970s. I've done videos on that before. I hope you can go back and see it, because it's all about economics and culture and things along that nature. And I also recommend you guys check out Mr. Thomas Sowell. He is a amazing economist and philosopher. Check him out. Thank goodness he's still alive today. And if you want answers, go see this gentleman. Go check out his books, go check out his videos. He is absolutely excellent. Now, to those of you who are gloating at this point saying, I knew it, I didn't want to buy, I wanted to wait till the market crashed. Look, nobody knows unless you have a crystal ball or someone you know has a crystal ball I don't know about. Those who say they know don't know. Nobody really knows, okay? So what I just mentioned about prices falling 12%, maybe 18 or 6%, that's if it was to happen this year. It could happen in 2023, 2024, and at that time prices could still stabilize and go up a little bit further than it is today. So keep that in mind. But let's just go on the topic that prices do fall 12%, right? Consider this. In 2021, prices went up anywhere from 15 to 20% in 2021. In 2022, prices have already gone up around 10 to 15% in certain markets. But let's stick with 10%. If prices fell 12%, that would take away all the gains of 2022, correct? Now, 2021, it would eat into that equity of that 2%. So it would only get into 2021, the very tail end. So if prices fell down 12%, it would just go back to the very end of 2021. So prices really didn't fall that much. So I just would like you to consider that. Buy when you can, buy when you're capable and able to, you have stable income, and hold on to it, and then buy other property if you're fortunate enough to be able to. Those who own, highly recommend you keep it or grow and get something further or buy multiple properties, because in the United States, that's how people build wealth, through real estate along with other international markets. Depending on the equity you have and the margin of equity, you can always use that equity. But I always recommend you do it the smart way. You can use a HELOC loan, but make sure you're utilizing it for return on investment. Unless you need have an emergency and you need an emergency fund of some sort, you can tap into that, but always build your own emergency fund to begin with. In any case, I hope you had a great experience watching, and comment below, subscribe, like, and let me know what you think. Thank you.